Hello and welcome. This is a special telecast we have for all our viewers of ET Now, analyzing how the market is actually taking all the macro headwinds which it's been facing. The market had a terrible week, the entire week gone by, and it's got to do with the fear how economy will absorb the crude impact, what will happen to inflation. FI flows already has been on a negative spree for last several months now. So it's actually taking a look at the markets from the macro standpoint. I've got a special panel for you to help us analyze, and these are gentlemen who have actually really navigated through the markets, both equity markets and bond markets, through cycles. Nikunj is also joining us on this special telecast. Prashant Khemka of White Oak, Maneesh Dangi is a macro investor and a veteran bond fund manager and CIO. Is also on the show. Of course, Nikunj is also here. Nikunj, let me come to you to set the context first. It has been a very difficult week. It appears that bear grip is tightening on the market, and this time all this nervousness is being accentuated due to the macro worries. How are you looking at things?
Ajay, I'll divide the market into two parts, the short term and the medium to long term. Or let me divide the market into not the time horizon, but with your approach, trading as well as investment. Is this the best time to trade? Certainly not. The charts are broken down. There is huge amount of volatility. Forget about overnight positions. You don't know what is going to be the market bent on an hourly basis. On Thursday, the market started gap up. They closed at the lowest point of the day. Friday, market started gap down, but they recovered towards the second half of trade. So within a day also, this market is becoming very difficult to call. And if you're a trader out there, either you trade shallow or you trade intraday or you stick to your stop losses. This is a time when you really have to have a disciplined approach if you are trading. It would be very enticing to see that markets are giving you big moves, but it's not difficult to capture those big moves. We can magnify these big moves only at the end of the day, and in hindsight say that, look, I had a sense that the market would fall, a market would recover. So don't do that. But when charts are damaged, when there is fear, when there is no light in sight, so to speak, that is the time when markets start becoming an attractive destination for long-term investors. Ajay, market 70% of the time they trade at fair value. It's only remaining 30% of the time market either get overvalued or they get underpriced. What we saw after 2008 and in May 2020 was a second degree deviation, absolute dislocation of prices. That has not happened. What we've seen is the excess has got corrected, and a lot of market now is fairly valued and is offering value or is offering attractive entry points in some key stocks. That is what you should focus on. Focus on individual stocks if you're an investor rather than taking a view on the market. And if you're a trader, maybe this is not the time to buy a J or trade. Why? Because let the tide turn. Let something happen on geopolitical front. Let something happen on the crude front. Let something happen on the Fed. It is better to buy a decisive turn rather than preempt the next move.
Right. Thanks very much for that, Nikunj. We'll come to you in a moment. Prashant and Maneesh are also here with us. Well, it's a equal, bull versus bear argument. Maneesh, I know you have your list ready with the macro worries. We have to, India as a country will have to, and many others, negotiate for next couple of months. But at the same time, there is also valuation comfort which has started happening. The trailing valuation of the market is at 21-month low. The forward earnings has also fallen sharply back to its 5-year average. But how real and how meaningful are these macro worries? We have faced such worries in the past as well. Maneesh, you go first. Right now, the worries on the table, and how meaningful do they appear as we stand?
So Ajay, I'm not going to repeat everything that I've said over the last few months on your shows, that the financial conditions tightening, crude actually getting supply side shocks, and that is not a good setup for any macro thesis, for risk. And which is why for 4-5 months, 5-6 months rather, I've been of the view that people should dial down, more specifically on small and mid caps. But right now we're sort of in a shock setup, which is not a pure, generally transitioning from is reflationary cycle to mid cycle. The shock is that suddenly crude is deviating dramatically from its trend line. Now we have been served a $60-70 billion worth of bill by the rest of the world in the form of higher crude prices, higher fertilizer prices, coal prices, and so on and so forth. Who's going to foot the bill of this $60-65 billion? One of the balance sheet, of course. Either it's going to be government, and if that is so, then it's almost about 1.5% of GDP. How is government going to fund this? By borrowing more? Of course, bond markets are not going to like it. So if you borrow more, then of course, you would have much higher interest rates. Or perhaps, what most likely government would do is actually a rundown on its capex budgets. And so are you sort of prepared for this, for the very good that we, celebrated after the budget? Most probably that will not happen given the context that we are in. Alternatively, this can be funded, the $60 billion worth of bill can be funded by other balance sheets, which is households or corporate. They are already, households are already scarred. If you actually push more into their, throat, then most probably they would actually slow dramatically, and you're not going to have the housing boom that you were anticipating. If you do it through corporate, then of course you have to increase taxes, which of course markets are not going to like. So in a sense, this is not a very good macro setup, not just for the regions that I have mentioned for the last 5-6 months. This is actually a pretty big shock. And, we need to, as a country, solve this, that someone has to bear this. And either scenario that you sort of painted is not going to be a good deal for bond markets and equity markets both.
Okay, let's go to someone who has been wearing a FII hat for some time now, and now is very active in building a domestic-oriented business here in India. Prashant, you have faced these kind of macro worries across emerging markets before. India is, of course, your home field. How are you really playing at this field right now?
Certainly, Ajay. First of all, thank you for having me on the show here. And hello, Nikunj. Hello, Maneesh. So see, near term, there is certainly a lot of uncertainty right now. Right? It's not the first time that the market has seen uncertainty. If you look back just over the last 5 years, 6 years time frame, or even 10, 15, 20, over any time period, the world does come across such uncertainties all the time. When you are present in a certain event like we are right now with the war going on in Europe and all, it always seems like it is the biggest uncertainty that we have, the market has faced in a long time. But remember, COVID was just 2 years ago. And arguably at that point in time, exactly 2 years ago, at this point in time, in early March, there's a question mark on the future of mankind, whether we'll ever be able to get back to a normal life. What would be the loss of human life that the world would suffer? What would be the changes in lifestyle that might be permanent? How long the lockdowns might sustain, and would they be a permanent feature for many, many years to come? So during that period of about a month, from February 20th to March 20th, March 23rd to be more precise, the market was struggling with these uncertainties. Market did not have an answer, even a vague answer. Market, isn't necessarily looking for precise answer, but market does not like such high degrees or elevated level of uncertainty. But if you recollect, from March 23rd, the market started rallying quite strongly and never looked back. Since then, market rallied more than 50% over the next year and a half or 2 years. Even though the worst of the fallout of the pandemic came after March 23rd. I remember on March 23rd, the case count in India was reported case count in India was less than 100 that day, about 75 or so. Total case count was only 500. And I'm not missing any zeros in front of them. the total deaths in India till that was in single digits. Right? So if you had been told that so many millions of people would be infected going forward, so many hundreds of thousands or more would die in India and around the world, many millions, at that time, it would look like a very, very grim picture. If you had known exactly how the pandemic would have played out over the next 2 years, on March 23rd, 2020, you would have felt there is no future for equity market. Yet the market climbed up through these difficulties that the actual world and the economy was suffering. Indian economy was down 7.5% that day. Unprecedented, right? We don't know if any time back in the history, in the past, there was a minus 7.5% kind of a hit to the economy. So the reason the market looks beyond these issues after a while, it has to get some handle on the extent of downside, whether it is a bottomless pit or is there a floor somewhere. Market doesn't have to be 100% sure of where the floor is, but get some feel that there is a bottom somewhere. Same thing happened during the global financial crisis. Market turned very sharply in March 2009, and leaders globally kept saying that the worst is still to come, and the worst still did come afterwards for the economy. But the market looked past that, because market ultimately is a discounting mechanism, is a present value of perpetual cash flows. So Indian market is $3 trillion worth, right? What is that $3 trillion? The $3 trillion is present value of all the cash flows of the companies in the market. Now, this problem that we are having right now in the macro front, it would impact cash flows, corporate cash flows, call them earnings or whatever, for the next year, 2 years, maybe a little bit longer. But how much of a dent is it to the present value of the $3 trillion? Is it $100 billion? Even $100 billion. So Maneesh pointed out $30 billion. Who's going to foot the bill? And yes, somebody would have to foot the bill, and it will be the country overall. Some part of the bill would be footed by the government, some part would be the corporate, some part would be the people. But in the $3 trillion value of these companies, $30 billion is but 1% of the value, right? I'm saying you triple it, quadruple it. Sooner or later, market would look past it, as it has in the past crisis. Right now, though, the market is not sure how much uncertainty is there. War is going on. It seems like it will stay contained within a finite geographic area, but you can't be sure. There is a small tail risk that it gets out of hand because there are nuclear reactors and nuclear capable countries involved. What would be the nature and scale and scope and endurance of sanctions that would come? And what would be the impact on the inflation and economy? As soon as market gets some intuitive sense, market would start recovering and rallying. And rallying may be too strong a word, but recover or stabilize well before the market men or experts become comfortable with what's going on in the world.
That's a very good reminder actually for our viewers that market is actually a discounting machine of the future. But of course, in the medium term or short term, that process of discounting could be a little painful. But for long-term investors and people who are playing the long game as far as investing journey is concerned, how should one be looking at all these issues? We'll be continuing our discussion after this very short break. So gentlemen, please stay with us. Welcome back. Still watching ET now, and the show is Economy and Markets 360. We have Nikunj, Maneesh Dangi and Prashant Khemka in conversation with us. Nikunj, you heard very interesting points from Maneesh as well as Prashant, especially the point of who would fund the balance sheets which are getting stretched, be it the government balance sheet, be it corporates. We already saw margin pressure, and even citizens as consumers. So, is it the time to make portfolio allocation yet? Are you looking at valuation comfort starting to arise in the market or not yet? Or do you see this macro worry linger on? Because FII selling is also not stopping.
So that's been the overwhelming factor, frankly, Ajay. I mean, we've always said that foreign institutional investors are our fair weather friends, and they've always bought at the peak of crisis. You've seen that, let's say, in 2013, you've seen that in 2018. It's the flow of FI liquidity which really has kept this market going. So you got to ask yourself that why are they selling? Is there a compulsion in nature? Is there an India specific factor? Or this is just the macro orientation of the world which is changing? Most of the long only guys you speak to, Ajay, who essentially are stock pickers, they are not in a very desperate hurry to sell. But the selling, then if it is $14-15 billion of net outflow, where is this coming from? Well, the selling essentially is coming from ETF, macro dominated funds, emerging market domicile funds, and they are typically in a sense anchored around interest rate, dollar index, and what will happen to P multiples in terms of mean reversion. So if interest rates go higher, if crude goes higher, if there is a case for P mean reversion, some of these algorithm based funds they normally take some chips off the table. So the selling only has intensified ever since crude has started going higher, ever since interest rates have started going higher, and ever since we have seen a big shoot up in market valuations above the historical averages. So you put all these three together, if in macro fund you would say, look, it's time for me to sell India because there is going to be a valuation risk, there is going to be a macro risk, and now suddenly there is an energy shock which has also hit us.
We will pose that question to Maneesh, who is running a macro fund actually. But before that, let's go to Prashant. Prashant, you have a overseas piece as well, and full time you've also been an FII. When you speak to your peers in your circle, which are the ones which are really selling down India right now, and which are the ones who are holding on? Because that is also a point of what category they belong to, and FII should not be really seen as one homogeneous mix, one big common kind of a body. Prashant, you're still on mute.
Apologies for that, Ajay. What I was saying, as Nikunj was saying, and from our perspective, what we are seeing, it's not, we haven't seen India dedicated investors selling out or trimming down. Yes, there are always some puts and takes, some people are selling, but the others buying. So net, we haven't seen any outflows. If anything, over the last 2-3 years, there'll be some modest inflows from an India dedicated perspective. However, the bulk of the money invested in India from foreign investors, the majority, the various estimates, maybe 2/3, maybe 3/4, comes from non-India dedicated investors. So global equity investors, global emerging market investor, Asia investors, and so on and so forth. So if Russia is having trouble, or earlier last year when China had its issues with the policy changes in tech companies and other areas, and the outflows from asset classes. So let's say if EM is facing outflow, then the EM managers are going to sell a sleeve. Oftentimes, if it's ETF, they sell a sleeve, and even if it's actively managed money, they have to provide the funds for outflows. And as part of that, there would be selling in India as well. So I think bulk of the selling that we have seen from our perspective, it is coming from these multi-regional and global equity funds.
Maneesh, they say that never ask a fund manager alone what does he think. Ask him what is he doing, and you'll get a much better view of his thoughts. So in your macro fund, have you started loading up on risk or not yet? Have you started reducing your long commodity type of bets? Because you have been holding this thought for 6 to 8 months now, as we have been interacting, and the narrative is actually playing out in the same way. So have you started winding your position or not yet?
So Ajay, sort of I've begun to unwind my long crude trade, which I sort of shared with you, which I started, about a year ago. I am flipping my energy exposure to hyper growth of US. That's something that I've written, in last 10, 12 days. That's the only very, very small piece of the equity market that I like. Everything else is, as you said, markets are discounting machine, and right there in future, there's a lot of lollipops. The problem is future inherently is uncertain, and basically we have few toolkits, through which you can sort of assess how the future uncertainty would be, positive or negative, in terms of its distribution. As it looks today to me, that the uncertainty on future is more left side one, meaning the one which actually can be more malignant than a benevolent one. Prashant was talking about, of course, pandemic and post-pandemic recovery. I was, of course, one of those ones, end of March, I began to dial risk significantly and pretty much loaded portfolio on equity, because, that was a good setup for India and for the risk taking for the world at large. Ajay, in a sense, crude was low, financial conditions were super easy, fiscal overplay was, unprecedented. And of course, people who understand macro understood that, the profit cycle would actually turn for pretty much everywhere because of the cost cuts and transfers from fiscal. Just the reverse is in play right now. So it is true that over a long period of time, this will look like a wrinkle. Okay, but then, if you want to assess markets through cyclical frames, which is how I like to do, because as I said in the beginning, inherently, I do not buy into this idea that equity is a contract to deliver a certain risk premium forever. There are centuries and centuries when equities don't deliver. So I think the base camp of equity investors should always be, at least the cyclical ones, is to presume that unless uncertainties are actually biased on the right side, which are the positive ones, be careful of them. And right now, uncertainties, Ajay, are actually biased on the left side, meaning the malignant one or the wrong one, so to say. In that setup, it's not very sort of advisable to dial risk. And as a matter of fact, last point here, Ajay, that,
right.
Howsoever great that this equity setup in India is talked of, from the last big bull run when it ended in January 2008, we've delivered about 9% CAGR. So that's the balance sheet's capacity to expand in terms of profit, right, because our valuations are not cheap.
Maneesh, that's why the role of fund managers like you and Prashant actually is even more higher, to beat the market because of better frameworks and skills, stock picking skills. But don't scare our viewers away. India is in a much better space, fundamentally speaking, than many countries out there. And yes, we have to walk through this in the long term. And of course, it's all about asset allocation. But gentlemen, thanks very much for joining us today, all three of you, Nikunj, Prashant and Maneesh, to help our viewers make sense of what's going on so that they can take more informed bets. Thank you very much, all of you, for watching this show, and goodbye.